All right. Welcome, everybody. This is our first time home buyer webinar. And just as a note, we are going to be recording this. So my name is Dominic DeMaria. I'm a Porcupine real estate agent right here in the great state of New Hampshire. And I am joined here today by Liz Going from Prime Lending. Hi, Liz.
Hi, thanks for having me, Dominic.
Thank you. So we are here today to talk some tips, tricks, education, and resources for first-time home buyers. Hopefully we can answer some questions and give everybody an idea of what they need to be a first-time home buyer here in New Hampshire.
Perfect.
Great. Slideshow's working. All righty. So today's agenda, we're going to be getting ready to buy your home, financial assistance programs, going over getting into your mortgage, getting a mortgage, and then the steps it takes to buy a home. So we'll be going over these in depth as we go through the presentation. So getting ready to buy a home. We're going to talk about credit. What is credit and how do you improve? Bad credit, what is good credit? All of that fun stuff. And how do you find a good realtor? So pre-qualifying for a mortgage. Why don't we start right at the very basic aspects of a mortgage? Liz, what is a mortgage?
Well, a mortgage is just a loan that you obtain in order to buy real estate. In real estate, we use a lot of really complex terms for super simple ideas. So instead of calling it a home loan, most people usually refer to it, it's technically called a mortgage. And there are several different types of mortgages, and depending on what a person's individual qualifications are for a mortgage, that will help dictate, which programs might be a great option for them in their unique situation and what they're trying to do.
So as far, go ahead.
Oh, go ahead.
I was gonna say, so know what you can afford. That's basically one of the biggest things here. How do they factor, like, what are the factors that contribute to what you can afford for a mortgage?
Yeah, so as mortgage lenders, basically what we look at is we look at what someone has for income, what they have for debt, and what is their capacity to take on more debt, aka a mortgage. When somebody is pre-qualifying, there's really the 4 C's of mortgage lending, if you want to call it that, which is capacity that we just talked about. There's credit, right? We got to look at your credit score and see what your credit profile looks like. The amount of cash on hand. I don't mean literal, cash on hand. I mean, documented assets. How much money do you have set aside for home buying? Because that's going to help tell us, are we looking at, 5, 10, 20% down programs, or are we looking for 0% down or cash assistance programs to help with the down payment? So you can see that's a pretty important C. And then the last C is, of course, the collateral itself, because not all houses, unfortunately, will qualify for financing, whether they are too dilapidated to be financed and they require renovation financing to fix them up so that way they're habitable, or what type of house it is. Is it a condo? And if it is a condo, is that condo project, do they have sufficient reserves, rules, things like that that go along and that make them approved for financing? So there can be a lot of reasons maybe why a collateral might not fit with a given mortgage program. So those are the 4 C's: cash, credit, capacity, collateral.
And then as far as like down payments and payments, they factor in how much you said, like, what did you say, capacity to take on a payment, right? That's what you said there. Lender determines what is left for more debt, usually capped at 45%. Is that a calculation that they can do on their own, or is that something that they would want to talk to a lender and kind of figure that stuff out first?
So we actually do have a kind of like a quasi example in this presentation that looks kind of similar to the qual sheet that I use when I have my consultations with my clients. Where we talk and we have where we interview and we discuss, what do you have for income and what do you have for debt, do a quick little bit of math. and then figure out what that translates to. And just as the presentation says, it's usually capped at around 45%. Some programs let you go a little bit more. Some programs are a little bit more restrictive. So again, the pre-qualifying process really helps you to figure out, which boxes that you are going to have to choose from in your home buying and mortgage experience. So, yeah.
It looks like I do have a question here. Is it better to use a credit union or a regular bank when it comes to securing a loan?
Yeah. So I always tell people whenever you can lend local. Credit unions, they sometimes have, special programs because they're lending their own money, right? So a credit union can be clutch, or a small community bank can be clutch for some weird properties that might not fit traditional mortgage financing, right? Because it's a small community bank that maybe knows the area and feels more comfortable lending their assets out. Regarding other programs, though, sometimes credit unions or smaller community banks, they can be a little bit more restrictive. As we talked about, 45% debt to income ratio, maybe a smaller community bank might be a little bit more restrictive, and maybe they cap you at 40% debt to income ratio, which is that number of how much money is coming in versus how much money is going out. So, overall, whoever you want to work with, you want to work with somebody that you're comfortable with, because, you're going to be talking about really intimate details of your finances, your background, your credit, things like that. So whoever you use, you want to make sure that you're comfortable with them. But I always, always, always suggest, especially in a state that's small, and they say 6 degrees of separation, but I'm pretty sure in New Hampshire it's 1 degree of separation, that you're using a local lender, because, a local lender is going to know the area. They're going to know the caveats of our closing process. They're going to be able to help guide you through insurance, finding a good homeowner's insurance person, as well as a title company to help, close the deal for you.
Right. And it also takes into consideration a lot of the unique things to New Hampshire as far as programs that could help first-time home buyers. So a national company might be able to get you a decent mortgage or something like that, but they might not be able to take advantage of all of the special credits and things like that you could take advantage of with a local lender.
Yeah, you're totally right. And a lot of the times these programs that are from New Hampshire Housing, we'll just talk about them because they're the biggest organization. They have a lot of the down payment assistance programs and first-time homebuyer programs that give really, really stellar rates that, like, the big box online lenders, they are not allowed to finance with these companies. So by using those big box online lenders, you are not going to have these types of programs available to you. So another benefit of lending local.
Great. All right, so we've got some math up here on the screen. So this is an example that you've spelled out here for us. So if you want to go over what we're looking at.
Yep. So here is kind of a breakdown of what we were talking about in determining capacity. In this case, we have 2 borrowers. One borrower earns about $5,000 a month. The other one earns about $5,000 a month, and the other one's $4,500 a month gross. And again, in mortgage, we use gross. We don't use, what's left after taxes and insurance and all that stuff. We just use your gross. So if you make $30 an hour, we're qualifying you off of $30 an hour. You'll notice in this case, these 2 borrowers, borrower number 2 also earns $850 a month in child support income. In mortgage, we can use child support income, we can use alimony, separate maintenance. If you have foster children, we can use foster care income. We're basically looking to make sure any of that type of income is documented, stable, predictable, likely to continue. So with these 2 borrowers, with all their income to combine, they make about $10,000 per month. In terms of monthly debt, they got a car payment that's about $600. They've got 2 credit cards, both going out every single month, is to the tune of about $260 worth of credit card debt between the 2. Borrower number 1 has to pay $500 a month worth of alimony. So yes, if you have to pay alimony or child support or separate maintenance, we do have to count that in your debt to income ratio because it is a debt that you're liable for, right? So altogether, these 2 borrowers have about $1,300 that's going out already for monthly debt. So as we talked about, we'll just use the number 50 because it makes it easy. 50% of these people's gross monthly income is about $5,175 that we can use towards their current debt and the new mortgage. So if we take 5,175, take out the money that's already being used for other debts, that leaves about 3815 that these people can use for a monthly mortgage. Now, when you pay a mortgage and you write your check every single month for a mortgage, it's not just for paying off the loan. A big part of that is going to go towards paying off the principal and interest, but there's also things like taxes and homeowners insurance and sometimes mortgage insurance, depending on the program, that you're going to also have to pay for. So in this case, if we have $3,815 that we can quote unquote play with for a mortgage, we take out 500 from that, take out another 100 for homeowners insurance, take out another 100 because this particular program involves mortgage insurance. That leaves about $3,115 that somebody can use towards principal and interest on a mortgage. And that number right there, that $3,115, that is what determines the loan amount. So this would equate to about a $450,000 loan amount. So, if somebody is going to bring in a $30,000 down payment, well, they can afford up to buying a $480,000 house because they're going to put 30 grand down and bring that loan amount down to what fits in with that number. Does that make sense?
Makes sense to me. There's a lot going on the screen, but it's all pretty spelled out here. And it's important to know that this is the kind of work that you do when you sit down with someone. You figure out all these numbers, you look at their income, their debts, and all that kind of stuff. And I will note too that the most recent survey showed that the average, or the median, I shouldn't say average, the median home price in New Hampshire right now is $479,000. So that does seem like a very shocking number, but when you spell it all out like this, that takes into account a lot of factors though. So that's the median. Doesn't mean that that's the only price that you can pay for a house in New Hampshire. So.
Right. And can you tell us a little bit like Southern New Hampshire? Is it more than Northern, Western, Eastern, whereabouts?
There are deals to be had in all sections of the state. However, in general, the more southern you are, the more expensive the house and the property tends to be. The closer you get to any border, it tends to get more expensive. So the closer you are to Massachusetts, the closer you are to Vermont, the closer you are to Maine, they tend to bump up just a little bit because people like our tax structure. So they live here and commute into the other communities. The further north you go, the farther your dollar stretches, but it comes at the cost of convenience to a lot of other things. So in general.
Okay.
This is the next slide, right?
Yeah.
Or is this the same one?
Nope. So this one's slightly different. So this just goes into account if somebody's trying to buy and quote unquote house hack, right? Where you buy a house that maybe has another unit and you're using the rental income to help you qualify. In this case, borrower number 1 earns $5,000. Borrower number 2 earns $4,500 a month. But you can see they're going to buy a 2-family in this example. And so when you're buying a multifamily, depending on the loan program, you can use up to 75% of the gross monthly rent amount to help you qualify. So I didn't want to compare apples to too many different oranges. So instead, I just kind of swapped the child support for rental income just to conceptualize it.
Sure.
But in this case, these people want to buy this duplex and the other unit rents for $1,113 per month. 75% of that would give these borrowers $850 of rental income that they can use towards their gross qualifying income. And we use 75% to account for vacancies, maintenance, that kind of stuff.
Okay, so it doesn't really change too much of the numbers, but yeah, this is great. Yeah, the house hacking is a great idea for people who can do some fix it kind of stuff for themselves. Also, there are options with property management companies like Ledgeview Commercial who will take care of everything and just send you a check at the end of the month for whatever the overage is. Obviously, there's a flip side to that too, but that's how that works. And it should be said that the more units you have, the more income this would be coming in. So this is off of a duplex. If it was a 3 to 4 unit, also that would increase the buying capacity because that money goes toward what you can qualify for.
Right. So, multiply 850 times 3, right? If they're going to buy a 4 unit, now all of a sudden we have 8, 16, $2,400 worth of additional income on the application. Imagine what that's going to do to the purchase price and
Right.
your buying power.
And up to 4 units is still considered a residential loan. Anything over 5 or over is considered a commercial loan. So that's a whole different program. So.
Right.
Okay, so where do all these numbers come from?
Well, so as we kind of talked about, your monthly mortgage payment, principal, I talked about it, principal, interest, taxes, and insurance, just rattle it off. But what does that actually mean? Principal is the portion of your monthly mortgage payment that actually goes towards reducing the balance of the loan, aka the principal that you owe. Interest, right now, while interest rates are higher, we see a lot more money go towards principal, or excuse me, at interest at the beginning of a loan and more towards principal towards the end of a loan. So in year 30, don't be surprised at how much interest you pay compared to year 29. The numbers kind of flip as the time goes by. Taxes, this is I usually factor in around $500 to $600 per month when I'm qualifying someone, depending on the purchase price of the house and the town that they are. Every town here in New Hampshire is different and taxed differently. Some taxes are as high as, $20,000 a year. Some towns' taxes on that same house might only be $10,000 a year. But either way, when you buy a house and you're using first-time home buying financing, you're generally going to have to allocate money every single month to be stored in this account that's called an escrow account, which is basically just a savings account attached to your mortgage from which your property taxes and your homeowner's insurance pay out. Like I said in the beginning of this, we have a lot of complex words for really simple for really simple concepts in mortgage and real estate. So when you write your mortgage check, you take, so say your property taxes are, $6,000 a year. We're going to hold back 500 every single month. We're going to collect 500 extra dollars from you every single month on top of the principal and interest. So that way, when your taxes come due, there's enough money in that savings account that the mortgage company can go and pay for those things on your behalf, out of sight, out of mind. You don't have to worry about getting a $3,000 tax bill during the middle of Christmas season or during the middle of the summertime. All of that is taken care of. And a lot of the times you get a slightly more competitive interest rate if you elect to escrow, because the bank feels more secure knowing there's not going to be a property tax lien slapped on their collateral. Does that help break down the monthly payment?
It does, yes. And so we also have what's due at closing. So down payments, what is a down payment?
So a down payment is how much money you are putting down on the house. So say the house is going to cost you $300,000 to buy. Depending on what program, you are going to bring in your either $0 for USDA and VA loans, or 3% down, which would be $9,000 for a $300,000 house, or 3.5% down payment on FHA loans. So there's a lot of different options. There's also 5% down conventional if you want to buy up to a 2 to 4 unit property that they just rolled out this past year, which is another neat way for people to get into a multifamily without having to shell out the normal 25% down in the future on an investment property.
And for a multifamily as a first-time home buyer, you do get an incentive there because first-time home buyers put less down in general than they do for a second investment property, right?
Right. So you could use FHA or conventional or VA to buy a fourplex. We'll just call it a fourplex, a 4-family house, right? For 0 to 3.5% down. Now, if you decide to buy, if this is something that you want to do, right? If you want to be somebody that has an investment property someday, I highly, highly, highly recommend that you buy a multifamily first. Because if you buy a single family out in the suburbs and then you want to buy a multifamily in Manchester, you're going to have to put down 25%. That's where you're going to have to do it. So you're not going to get that perk. So if this is something you want to do, you know, use your low down payment perk to buy your primary residence, live in it for a year, and then go buy your dream house. You know, because it's a really, really awesome opportunity. I can't stress it enough, to do it in that particular order. You can't
I
go back the
regret
other way.
not doing it for my first house in New Hampshire. So it would have been a very nice incentive. So
Yeah.
So we talked about escrow and closing costs. So closing costs can be intimidating to a lot of people because it is a lot of money to pay at the end of the process, basically. So can you talk about what goes into those closing costs?
Sure. So closing costs, these are basically the fees for the legwork, of getting your loan done. There's kind of two categories of closing costs. You have, I usually just blanket them, but if you want to get into the nitty gritty details, there's two different categories. There is your closing costs, which is the legwork and the manpower and, you know, the wages that people have to get paid to do the work. These are things like lender fees. These are things like attorney fees. So these are all in that one particular category: your appraisal, credit report, flood cert, all these sorts of things, the things that you have to actually pay for to obtain financing. The other part is your escrows and prepaids, which we were talking about before, setting up that account. Because say, for example, you're going to close, say for example, you buy your first house and you're going to close in April. Okay. Your first mortgage payment isn't going to be due until June 1st.
Right.
But guess what happens on July 1st? You have a 6-month property tax bill due. And if you only made one mortgage payment, you're obviously not going to have enough money in your escrow account to pay for that property tax bill on July 1st. So at closing, we'll actually collect five months worth of property taxes and put it into that escrow account. So that way, when that property tax bill comes due, the account is solvent enough to pay for those fees.
Gotcha. Makes sense.
Yep.
I do have a question in the chat, and it is, so if you live in a multi-unit for a year, do you then get the low down payment options again when you buy a single family home?
That's a really good question, and it's complicated. The government doesn't want you taking advantage of these types of programs to build a real estate portfolio, right? So it's got to make sense. If you're going from a single family to a 4-family, that is not going to make sense to an underwriter that you are going to enjoy your life living in a 4-family, you know, when you have been living by yourself, secluded out in the middle of the woods. Like, nobody's going to believe that you're going to be, because the key to all these programs is that you're owner occupying the property. So if you buy a 4-plex first, you know, nobody's going to ask any questions. You've never owned a home before. Who cares what you're doing? Now, if you want to buy another 4-family with 3% down or 5% down or 3.5%, you are going to have a really tough time helping an underwriter pass the sniff test of occupancy. And you and I might know that you are truly going to move, but unless you have a good reason that, you know, your job relocated you from Manchester up to Berlin, New Hampshire, so you're going to buy another 4-family up in Berlin, you know, it can be difficult. It's easier to go down. So if you go from a 4-family to a 2-family, that can be different than going from a 2-family to a 4-family.
Right.
Yeah.
But it's not impossible. It's just, it's going to take a little bit more doing, I guess you would say.
I would say if you're going to downgrade the number of units, you're going to have an easier time than upgrading or staying the same, unless you've got a good reason.
Okay, credit scores. So getting your credit score and how to improve it. Let's talk about this. So what do lenders look at?
So regarding your credit score, you know, we look at the credit score, we look at the number, of course. Most lenders will go down to around 620, 600. We'll go down to 580. Some other lenders might go down to 550. So if you're in that area, it's important to talk with multiple lenders if you have lower credit, because different lenders have different appetites for risk. Credit scores go up as high as 850 with mortgages. If you have above 780, nobody really cares anymore. You're in the top tier. So don't sweat that too much. We do look, you know, to see if there's been any bankruptcies or foreclosures in the past. We take a look at the whole credit report, see if there's any charge-offs or anything like that we have to deal with or contend with potentially. But you know, the numbers are a really big thing.
So step one, if you have a credit score that's lower than 600, does it take, is it even worth applying, or should you just work on your credit before you start doing anything else?
You can apply. Like I said, some lenders will go down as low as 550 that I know of. Some there are ways if you don't have credit score. Some programs have specific guidelines. You know, if somebody doesn't have a credit score, this is what we need to do. And this is what we need to establish in lieu of a credit score. So it really depends. So I don't want to say if you have below a 580, like don't try. If you have a lower credit score, it's going to be more expensive for you to buy a house. I'm not going to lie. Your interest rate's going to be higher than somebody who has, you know, good or great credit. And if your credit score is that low, there's a very good chance that you will probably have to pay points, discount points, to even secure an interest rate. So, you know, for me, I don't like to discourage people from applying. But you know, if your credit score is kind of, you know, down and things happen, right? Life happens.
Sure.
Sometimes emergencies happen and your life blows up and there's nothing you can do about it. All you can do is recover. You know, so fixing your credit could be something that's worth it. I just had a couple close on a refinance this yesterday. And I've been working with them for about 8 months and their credit started around 530 and they just closed yesterday on a refinance. And their scores got up to about 660 in
Wow.
about 8 months.
Yeah.
Yeah. So,
And that's something that you, as part of the services that you offer, you can kind of help coach with some of that stuff. Obviously, that's not what you do per se, but you can help give them ideas of how to improve that score.
yeah, I know. I mean, I know a couple tips of the trade, but I am definitely not licensed in credit repair.
Right.
But I know a really great company that is, that, you know, I've had clients that have had tremendous success with. I've got a few clients that are in their program right now. And just watching their scores go up every single month it's really, really exciting because again, credit happens and, you know, all you can do is try to pull back. If you have a bad year, you know, most of the time you can fix it in another year of just doing the work. So not all is lost.
Okay, so the credit questions that we had here were what credit score do I need? But we kind of addressed that already. So, and okay. So what else did they look at? They look at debt and
Yep.
yeah, we've covered all this, right?
Yeah.
Is there a way to figure out, like, if you don't know your credit score, is there a way to pull that somehow? How would you go about doing that?
Yeah, so you can get your credit reports from each bureau. There's 3 different bureaus, right? TransUnion, Equifax, and Experian. You can get your credit report for free from them 1 time per year. So if you want, you can pull one every quarter. Or you can use free credit monitoring services, you know, like Credit Karma and stuff like that. You know, it's a free service. And it's not necessarily correct because there's about 27 different FICO scoring algorithms, but it'll give you a general idea if what you're doing is good or bad for your credit.
Right. Okay.
We do look at employment history. That is one thing that we do look at. A 2-year work history is required in a related field. It doesn't have to be the same job. So say, you know, you were a nurse at one hospital and then you switched to be a nurse at a different hospital. That's fine. Education can count towards that 2-year requirement. So I helped a girl one time. She had just graduated from college with an engineering degree, a civil engineering degree. She got a job in June. In July, she got a job with the city of Concord. And by September, she had closed on her first condo. So, you know, education can count, but it's 2 years in a related field or education.
Okay. There is another question here. Can you tell the name of that company that helps with the credit scores?
Yep.
Or
So
do it at the end, or we can do it now, either way.
yeah. So there's a couple that are out there. For me, I have a lot of success with My Credit Guy. I don't receive any sort of compensation from them. The only thing that I receive is success for my clients. But My Credit Guy is a company that I usually refer my clients to. I generally try to tell them to avoid the places that promise to get you out of debt. Because a lot of the times they kind of have you miss payments for a while and then wait for your credit score to rebound to get you out of, you know, if you have like too much credit card debt. You want to work with somebody who's going to be a dedicated repair company, and a repair company that's not just going to dispute everything on your credit report. You want somebody who's actually going to resolve the things on your credit report.
Okay, so home buying assistance. So New Hampshire Housing Assistance is a program that I went through a course recently on this. You probably have a little bit more than I do on it. You work with a lot of these programs. So what is New Hampshire Home Buying Assistance Program?
So New Hampshire Housing, it's what's called an HFA, which is a housing finance authority, which is a local government, quasi kind of state government run housing organization. And New Hampshire Housing is completely, self-solvent, or self-reliant. And they pay for themselves.
Self-funding.
Self-funded, yeah. But they have really, really stellar programs that can help with cash assistance to help you buy a house, or programs that have a slightly lower interest rate because it's an HFA. So they're able to get special pricing on the secondary market because they are a housing finance authority. So I use their Home First program a lot. I work a lot with veterans. And so, the rate on their Home First program, which doesn't require veterans to be a first-time home buyer to get into, it blows any rate that I have on my rate sheet out of the water. So that's a really, really great program. And then they have down payment assistance programs that are anywhere from $5,000 to $10,000 in cash assistance. And then this past year, they rolled out a new program called the First Generation Homebuyer, where you can get an additional $10,000 for being the first person in your family. So your parents cannot have ever owned a home before. But if that is the case, you can get an additional 10,000. So you could get, 10,000 down payment assistance and then 10,000 home first. All of a sudden you've got $20,000 coming from New Hampshire Housing to help you buy a house. So
and in order to qualify for these, there's a series of things that you have to do to get the money. It's not like they just hand it out at the door.
right.
There's classes you need to go through and certifications and things like that you need to, take in order to qualify for them. But the money is there. If you're willing to put in some of the work, it can definitely help. I've helped several folks who are first-time home buyers take advantage of these programs. We actually just recently helped a veteran buy his first fourplex with New Hampshire Housing Assistance and VA loan. So yeah, that was very good. Wait, was there anything else on that slide? Yeah, I have a couple of questions. What about buying raw land? Does New Hampshire Housing help with any of that?
Negative.
No. Okay.
Negative. If you're trying to buy land, you're going to be looking for one of those smaller community banks that we had talked about in the beginning. Because they're going to need to determine if the land is buildable or not. And for that, there's different qualifications about land. I don't lend on land, so I don't even know. I just know it's a little bit more complicated and requires much more money down than these programs that
I tell people it's not as simple as buying a piece of property, clearing some trees, and putting a mobile home down on it. It's not. There's a lot of infrastructure work that goes into it, and the timeline is much more in depth than you think it would be. You're looking at a minimum of a year probably from time of finding a property to getting a house on it to live on. So not that it can be very rewarding. It works for some people, but it's not a quick, like, I'm just going to buy a piece of property and put something on it like within a couple of weeks. So
right.
What about buying a modular home? Would home buying assistance work for something like that?
Typically, no. These cash assistance programs, these are built for homes that are already existing. So to, bring in and build a whole new structure, these programs are not designed to do that. New Hampshire Housing, they do have a version of a 203K loan, which can help you rehabilitate an existing structure. But in terms of actually constructing a new one, this is not something that they're going to allow you to do. You can use New Hampshire Housing to buy a modular or a manufactured home that's already existing. You're going to want that to be on its own land, and not in like a park or a co-op. But that is an option. You can buy one that's already existing as long as it meets, the HUD guidelines, that you can go over if you'd like to, Dominic, or not.
Yeah, as far as buying a manufactured home or a mobile home, but that's what they call them now, manufactured homes. It can be done, but again, like Liz said, they cannot be in a park or a co-op, so it has to be on its own piece of property in order to qualify for a lot of the loans. And that even finding that is rare. There's a lot more properties that will fit your will fit the qualifications much more easily than that tends to be pretty difficult to find things like that out there in the wild. There is a question about mixed use properties. So what is a mixed use property, and would something like this qualify?
So it's going to depend. So first, a mixed use property is a property that is primarily residential, but maybe has a bit of commercial space to it. Maybe it's like a commercial garage that somebody, the person's a mechanic and they converted their garage into something with a lift and the hole in the ground so you can change the oil from underneath. I don't know what that's called. I don't even know how to change my own oil. But something like that could work. Something with a convenience store under it, that it can get kind of hairy because they're going to want to see that you're operating it, that maybe you have experience doing it. It depends. Or it could be a house that maybe has a back 4-season room that is a hair salon now. These types of properties are things that are lended upon all the time. It's going to depend on which program you're looking into, though, because each program has their own little caveats, nuances, and square footage requirements when it comes to mixed use.
So in general, it would be smarter to get qualified first and then start looking at those unique properties, not necessarily try to find a property that's mixed use and then try to apply for things with that in mind. Does that make sense?
Yeah, I would say so. I mean, because at the end of the day, if the mixed use property is 500,000 and you can only qualify for 300, what's the point?
Right. Okay.
Yeah.
Okay, down payment options and PMI. So down payment options, let's start with PMI. What is PMI and how does it factor in?
So private mortgage insurance is, what you're basically gonna pay as insurance in the event of default because you're not putting 20% down. Somewhere in the past, lenders decided that after 20% down, that you have a sufficient equity position that if they have to foreclose or you stop making your mortgage payments, that there's enough equity that, the bank should be able to recover their losses. If you don't have 20% to put down, you have to pay something that's called private mortgage insurance or mortgage insurance premium on FHA or the VA guarantee or the USDA guarantee fee on USDA loans. They all basically do the same. They insure the loan in the event of default. VA is the only program that doesn't have private mortgage insurance. But this number does factor into your principal, interest, taxes, and insurance figure that we talked about when determining capacity. So we do have to account for it.
So the type of loan you get and your credit and all of that will determine how much you need to put down on a house, right?
Yeah.
Or will factor in.
Yep. So private mortgage. So with FHA, their version of mortgage insurance is called the mortgage insurance premium. That's a set rate whether you have a 580 FICO score or an 850 FICO score. On conventional, it's going to depend on how much you put down and what your credit score is, what your PMI is. And there are 6 different private mortgage insurance companies that exist. And we shop each one to make sure that we're getting one that is going to give you the best rate for the lowest rate, whatever is important to you, and that will also insure that property as well. So, you want that number can kind of change when it comes to conventional. So sometimes maybe somebody who has lower credit might have an overall lower monthly payment by using an FHA loan rather than conventional, because maybe their 600 credit score isn't going to be punished as hard with FHA as it would be with conventional for the mortgage insurance.
So in general, does it, I know this is kind of a very broad question, but FHA versus VA versus conventional, is there one that's preferred over the other? Or is that just personal preference kind of thing?
So it can depend. And a lot of this is going to come down to your agent. You want to work with an experienced agent. Porcupine Real Estate, I know you guys, you work with everybody. I've closed deals with you on conventional, USDA, FHA, VA, and I know you guys have even closed deals in Bitcoin. So you guys kind of know your way around financing and how to propose it to the seller. But regardless of who you decide to work with as your real estate agent, you want to make sure that they're equipped to represent you well. and that they have experience working with the type of mortgage program that you're working with. Because if your option that your lender has laid out for you and you really like the FHA quote, and you have a real estate agent that's like, well, can't you just go conventional because they don't want to deal with FHA or deal with having to negotiate a little bit harder to get your offer accepted, that's obviously not the agent for you.
Right.
Because at the end of the day, the agent's not writing your check every single month. And if by going FHA is going to save you $200 to $300 per month over conventional, that's your business. And your real estate agent is supposed to be working in a fiduciary capacity to represent you. With VA, it can be tricky. But again, working with an agent who knows and is supportive and educated on the VA benefit and can, because believe it or not every lender knows everything and not every agent knows everything. And you get a lot of pushback from agents who who think that a house won't go one program or another because of one caveat or another. That's not even true. So you really want to make sure that whatever program you're working with, that your real estate agent is on board with supporting you and your wishes 100%. Does that help answer the question?
Yes. Yeah, I think because a lot of people see those letters and they're not really sure what they mean. So conventional is very traditional mortgage, whereas an FHA, there's specific things you need to qualify for to get to that. And VA loans are for veterans, right?
Yep.
Pretty much
Yep.
across
Veterans and active duty service members. Yep.
So there's one other question here, and it's what are the requirements for low down payments for conventional loans? Is there anything specific they should be looking for to get a low down payment?
Like in terms of like their credit, like to qualify, or like what are the different down payment tiers?
I guess what the low down payment tiers are.
Okay. So conventional, it's 3% down to buy a single family. If you want to buy a 4-family with conventional financing, it's 5% down. So a 2 to 4 unit, a multifamily with conventional is 5% down. Single family is 3%. VA is 0% down. USDA is 0% down. FHA is 3.5% down.
Okay. And qualifying for those, if you qualify for any of those programs, are those the set rates or does it go up from there? Is that like the bottom for those?
That's the minimum required down payment.
Okay.
Yep. So you can make a down payment above and beyond that. I have veterans that make a down payment even though the program's 0% down just because they want to lessen their loan amount.
Sure.
So that's just the minimum required. You can always put down more if you'd like.
Okay. And I think, is there anything else that you wanted to add to the, financing aspect of everything?
No, I just think that the most important part is just getting, pre-qualified because, a loan application is basically like putting a bunch of puzzle pieces on a table and you don't know what picture it's going to come up with until you put them all together. So if you're scrolling at 2 a.m. on Zillow, there's no reason why you shouldn't already be pre-approved at that point. Because if you fall in love with a house that's 700,000 and you can only afford one that's 400,000, we're just in for a lot of heartbreak. And that's my big takeaway.
It's very true too, because I work with a lot of people. I've worked with quite a few buyers. And if you're not locked and loaded and ready to go right out of the gate when you start looking, you're just setting yourself up for heartbreak because you're going to find something that checks every single box that you want and it's going to be a great price and you're not going to be ready to put that bid in because in this market, you can't even get a offer considered without a pre-qualification letter. Like it's not even worth trying to put in an offer if you're like, well, I've got to do this, I've got to do this, and I've got to do this before I can actually get the letter. The house will be sold by then. So, okay. So steps to buying a home. This is where I come in. So once you have your pre-qualification letter through Liz or another lender, but preferably Liz, then you start having the conversation with me. The biggest factor I would say is going to be budget. Unfortunately, that's the sad truth of everything is it's all going to come down to how much money you can afford to spend on this house. Identifying the kind of property that you're going to want, whether it be a single family or a multi-family, so you can do the house hacking thing like we talked about earlier. And then setting up that search based on the area of the state that you're interested in and specific features. So if it's minimum 2-bedroom, 3-bedroom, how many bathrooms you're looking for, square footage, a garage, any of those kind of factors. The broader your search, the more results you're going to get and the wider net you're going to cast when you're looking for those houses. So we have access to what we call the Collaboration Center, and that's an automated email search that will send properties directly to you as they come up on the market. So you can be the first to the open houses or the private showings or whatever it would be. We make that very easy for you. Then once you have something in mind, if you find a place that checks all the boxes, you've gotten the approval from your lender, then we can start making those offers on those properties. There are lots of different strategies for putting offers in. It's not always highest bid that wins. Sometimes it's the conditions of the offer. Those are all things that we can go over on an individual basis. Some properties you're going to want to do something called like an escalation clause that promises to beat the next highest one by X amount. Those are specific strategies, but we don't go over all those on something like this. It would be a case-to-case basis. Once you get that accepted offer, then we go into the home inspection phase. So that would be if you choose to do an inspection, which I always tell people is a good idea. It's a great idea. Then you would renegotiate or make repairs based on those home inspection results. Wait for an appraisal to come in from the bank and the lender, and then we get to closing and you get to move in. That's a very quick, dirty version of all of everything that takes place. And I know we have a question in the chat that says the whole process seems overwhelming. I would love to know the steps that we need to be diligent in taking to turn my dream of owning a house into a reality. Step-by-step process. I do have like a nice little buyer's guide that I can send anybody who's interested. Please reach out to me via email after this, and we'll go over that. But yes, the biggest thing is finding out what your budget's going to be so that you can be prepared to look at the houses that would meet your requirements. So
I have I'm a very visual person. I have a Monopoly board that kind of takes you around the home buying. So I can send that to you, Dominic, and you can send it out with yours for everybody.
oh yeah,
just in case somebody likes to see that visual of the
yeah. I think that'd be really fun. Yeah, I'd like to see that. So then I also have, can you use multiple resources at the same time as far as realtors and lenders, as well as assisting programs? So typically, you wouldn't necessarily want to use multiple lenders at the same time. You can get pre-approvals through any number of places, but once you actually select one and go under contract, you do have to lock into that within, I think it's 5 days from actual executed contract is typically the normal amount of time. So you do have to make that decision, but you can feel free to shop around. Most of the time, the standard rates are going to apply. It's just the personal connection or, things that you can get from the lender on a personal level. Like, would you say, well, how would you say that?
Yeah, I would say it's who you really click with.
Mhm.
Because I know that I'm not going to be everybody's cup of tea, and that's okay because I don't need to write every single mortgage in the state of New Hampshire.
Right.
So you really want to work with who you want to work with. But to answer that question, it's not like you can get $50,000 from one lender, $50,000 from another lender, $50,000 from another lender, and bring 3 different loans to the same closing table to buy the house. No, you can only get one mortgage. It has to be from one lender. And I wouldn't recommend using multiple realtors. I don't even think that you can, because you want one person that's representing your interests. Real estate agents, and something that I think is being lost in a lot of the conversation that's being had right now in this country about real estate agents is how they act in a legal responsibility for you. They have legal training to write these contracts, and they have insurance, and they have all these different protections and knowledge about the legalities of buying a house that normal people don't have. So picking one real estate agent that you jive with, that you like, and that is qualified and competent to support you, because they're going to be acting in your legal capacity, is paramount, I think, in the home buying process.
Yeah, and I think that's another good point too, as far as like the home buying process. I've closed almost 30 transactions in the past 2 years, 2.5 years, or whatever it's been. So I've done it many times, and most people do it maybe once or twice in their entire life. So you look at those kind of things, and it's, take the expertise that somebody's giving you and has available to them, and use that to your advantage. We don't expect you guys, any home buyer, to know everything that's going on in the process. We're here to make it easier for you between the real estate agent and the lender. So I have a question in the chat here, which is, what if you do not pay federal taxes? Can you still get approved for a mortgage?
What do you mean you don't pay federal taxes? So you're self-employed and you haven't filed your tax returns, I'm
Possibly.
assuming is the situation. If you're self-employed, and you get paid off the books, we have to document your income for the past 2 years. If you are a W-2 employee, we're going to be getting your last 2 years of W-2s and your 2 most recent pay stubs. If you're self-employed, we're going to be getting your 2 most recent years of your business tax returns and ascertaining what your income is on that. So we need documented income to qualify on a mortgage. We can use things like, disability. We can use things like Social Security, retirement, pension, like I mentioned before, child support, alimony, anything like that. If you've documented income, that we can document the continuance of in the past receipt of, we're good to go. But if you're self-employed and don't file
That
taxes,
might be, just to clarify, it might be that maybe the income is too low to pay taxes. Is that something?
okay. Yeah, that's fine. That's fine. Some people don't have to pay taxes, which is fine. That's not a big deal because that income that you're getting is from the government, So that's what we're going to use to qualify. And because it's tax-free, guess what? We get to gross it up 125% to help you qualify. So
Okay.
that's fine.
That would be an individual question, I would say, on a specific situation like that. So feel free to reach out and we can go over those kind of things. So, yeah, and again, the whole home buying process, I very much condensed it down there. So like going step by step, we can do the offline, basically. Okay. Are there any questions from folks who are actually here in the chat? If so, go ahead and punch those questions in, and we can answer those before we wrap up. And while we're waiting for some questions to pop in, we'll just go to our last slide here, which is our contact information. So again, my name is Dominic DeMaria. I work with Porcupine Real Estate, and my email address is here on the screen, dominic@porcupinerealestate.com. And Liz, the expert in loans here, is liz.going@primelending.com. Is there any other things that you want to plug as far as that goes, Liz?
I think I just have to legally plug the compliance stuff. So my NMLS number is 1818156. I lend in 41 states directly, and all the things that we discussed today are all, of course, subject to underwriting approval. The terms and conditions can apply, and they can change at any time. And any opinions that I gave, are mine and aren't representative of Prime Lendings. I think that's pretty much all the fine print that I have to put in most things.
One question did come up in the chat, which is, what is due diligence and what should we be looking at when looking for a home? That's a great question. Due diligence can cover a lot of things. That's going to be checking with your town as far as zoning goes, whether there's property insurance, flood insurance, any condo docs or association docs or anything like that. Basically, you can set the amount of time from going under contract to finished negotiations. Generally, I do 7 to 10 days, and that's your time to look into all those things that the town would have. So yeah, there's those kind of things. Typically, what I look at is the title company will do their work, which will be to check that the person who's selling the home actually owns the home and that there's no encumbrances on the title. So basically that there's nobody else claiming to own the house, or that there's no outstanding repair bills that haven't been paid. That would be like a lien on the house. So they take care of all that to make sure that there's actual clear title. And then in that due diligence period, that would be still part of the home inspection period as well. So I always recommend getting a home inspection. They do non-invasive home inspections, which means that they're not going to rip up floorboards to look at plumbing or anything like that, but they can generally do a very good job showing, you know, if there's any issues with electrical, plumbing, anything like that, any non-functioning appliances, things that you would want to have addressed prior to closing on the house. So okay, I think that brings us to the end. Well, I just want to say thank you again, Liz, and thank you for everybody who attended. We will be sending this out as a video to people as well, so you can reference it later, and feel free to reach out to myself or Liz with any questions you may have. No question is a silly question. Again, we do this a lot. You guys probably don't. So happy to help. All right. Thanks, everybody. Have a great night.